Imagine a business that charges, astronomical interest rates
Right.
to people with just terrible credit. And it operates in this notoriously gritty, highly controversial industry.
Oh, yeah. Constantly in the crosshairs of state governments and regulators.
Exactly. Got that picture in your head. Okay, now, I want you to imagine that exact same business was somehow one of the greatest, most disciplined, practically invincible wealth-generating machines on Wall Street for, like, a quarter of a century.
It is wild when you actually look at the history.
It really is. So today, we're putting Credit Acceptance Corporation traded on the NASDAQ under the ticker CACC, under the microscope.
Because it is, frankly, one of the most fascinating paradoxes in modern finance. I mean, the numbers on the surface have historically looked pristine, almost robotic in their consistency.
Yeah, but the underlying reality of the business is incredibly messy.
It's the absolute definition of diagnostic muddy waters.
Exactly. And that is exactly why we're doing a special AI Investment Memo edition of the Deep Dive today. We aren't here to do a standard quarterly earnings recap.
No, absolutely not.
Our mission today is highly specific. We are applying a ruthless, highly skeptical buy-side standard to this evaluation.
Which means we aren't just asking if credit acceptance is nearly competent.
Right. Or if they are, technically turning a profit. For you, the listener, if you are sitting there looking at your portfolio, the bar has to be much, much higher.
Way higher.
We want to determine if this business, and specifically its current leadership team, deserves exceptional long-term trust with your fresh capital.
And that framing is crucial, right? Because under this rigorous framework, our baseline assumption starts at not investable.
Oh, I love that.
Yeah, I mean, credit acceptance has to prove otherwise. They are guilty until proven innocent when it comes to earning a place in a high-quality, long-term portfolio.
I am so excited to dig into this because historically, CICC has looked like a compounding machine, like a total Wall Street darling.
They really were, for a very long time.
But today, we are going to look way past the polished corporate narrative. We're looking for durable economics, resilience under stress, and management credibility.
And we are going to focus on the how and the why behind the directional trends. We're not just going to throw raw numbers at you.
Please don't.
We are going to translate what those numbers actually mean for the actual survival of the business. Because if you are trusting a company with your money, you need the unvarnished truth.
You do. So to figure out if this machine is still humming, we really have to start by opening the hood and looking at the engine room. Like, how does this company actually make its money in the real world?
Well, to understand credit acceptance, you have to look at the mechanics of the deep subprime auto market.
Okay.
They're a specialized indirect auto finance company, meaning they serve credit-impaired consumers, primarily through used vehicle dealers across the United States.
Right. So you don't go to a credit acceptance branch. You go to a used car lot.
Exactly. And they do this using two very distinct structures. They have the portfolio program and the purchase program.
Okay, let's unpack this right away, because if you read their corporate materials, their press releases, the narrative is always, we are a mission-driven credit access company.
Right. We help marginalized people get cars so they can get to work.
Look, I have to push back on that immediately. This is not a charity.
Not at all.
It's a highly specialized underwriting, servicing, and collections machine. It's built to extract yield from deep subprime credit. It's much like, I don't know, a refinery processing heavy, sour crude oil.
That refinery analogy is spot on.
It's dirty, it's difficult, and it's volatile. But if you have the right specialized equipment, you can crack it and make a lot of money.
And the real business is exactly that, a specialized machine. And this distinction matters deeply for you as an investor.
How so?
Because if you think you are buying a beloved consumer brand, you are fundamentally mispricing the company. Consumers don't seek out credit acceptance because they love the logo.
No, they just desperately need a car.
Exactly. They need a car. And CPC happens to be the paper the dealer can get approved. The moat here, the competitive advantage, is strictly their process, and the portfolio program is the absolute masterpiece of that process.
So walk us through that. How does the portfolio program actually work in practice? Let's say I'm a used car dealer and someone walks onto my lot with a terrible credit score and they want to buy a $10,000 used sedan.
Okay, so in a traditional subprime model, a lender might just buy that loan from you, the dealer, at a massive discount.
Okay.
And then that lender takes all the risk. If the buyer stops paying in month 3, the lender eats the loss.
Right, the dealer's already paid and moved on.
Exactly. But in CCC's portfolio program, they don't do that. Instead, they share the economics and the risk with the dealer over time.
Oh, interesting.
Yeah. When you sell that $10,000 sedan, CACC gives you an upfront advance. Let's say it's $3,500, just enough to cover your actual cost of the metal, the car itself.
So as the dealer, I made whole on my inventory costs, but I haven't really made my profit yet.
Exactly. You're flat. Then, CCC takes a pool of these loans you've written. And as those consumers make their monthly payments over the next few years, CCC recovers its $4,500 advance.
Okay.
They take their 20% servicing fee, they cover their financing costs, and then, and only then, does it pay out the excess cash back to you, the dealer.
Got it.
This back-end payout is what they call dealer holdback.
That is brilliant because you've just forced the dealer to have skin in the game.
Massive skin in the game.
If I'm the dealer and I know I'm only getting my profit on the back end, I'm not going to sell a total lemon that breaks down in 2 weeks because the borrower will just stop paying and I lose my holdback.
Right.
And I'm not going to push a loan onto someone who clearly can't afford it either.
Precisely. It aligns the dealer's economics with the loan's actual long-term performance. It basically forces the dealer to underwrite the car and the customer alongside CCC.
That makes the relationship incredibly sticky.
Ooh, very sticky. Once a dealer has been using KCC for a few years, they build up a pipeline of these future cash flows, these holdbacks.
Right. It pays out almost like an annuity.
Exactly. Which makes it very hard for a competitor to walk onto that lot and just commoditize the relationship, because the dealer is financially tethered to KCC's ecosystem.
But there's a catch here, right? Because they also have the purchase program.
Right, so the purchase program is much more traditional. In that model, KCC pays the dealer a one-time upfront payment.
Okay.
And CCC keeps all the upside if collections exceed expectations. But crucially, KCC also bears much more of the downside credit risk.
And historically, they only grant access to the purchase program to more experienced, higher volume dealers, right?
Yes, they want to know you before they take on all your risk.
But here's where it gets really interesting for you, the investor, trying to evaluate this stock. That portfolio program, with its shared economics and complex holdback pools, it aligns incentives beautifully on the ground.
It does.
But when you zoom out to Wall Street, it creates a massive wall of complexity. It heavily obscures transparency.
Oh, complete.
You're trying to figure out the real profitability of the company, and you have these incredibly complex, multi-year shared cash flows where the company is advancing money, holding back money, taking fees. It's a labyrinth.
It was a total labyrinth.
Yeah.
Now, complexity can be a moat when it allows a company to operate more intelligently than its rivals.
Yeah. Sure.
But for an investor, that same complexity acts as a valuation discount the moment your confidence in management wanes.
Because you can't easily see to the bottom of the pool.
Exactly. You just have to trust them. And to truly understand why CEC operates with such rigorous, almost paranoid and highly complex structures today, we can't just look at their current balance sheet.
No, we have to look at the scars they acquired decades ago.
Right.
This is a crucial point. If you want to know why this company is built like a fortress, you have to look at the time the fortress almost burned to the ground.
The near-death experience.
Yes. Let's trace this back. Credit Acceptance was founded way back in 1972 by a man named Don Foss. And for the first 20 years, they operated in this underserved market niche.
Very quietly.
Right, incredibly high profitability, completely under the radar. Then they go public in 1992, an IPO, and we all know what happens when a niche, profitable company goes public.
Wall Street demands one thing.
Growth.
Growth. And they chased that growth aggressively. I mean, from 1992 through 1996, they expanded rapidly.
Yeah.
On paper, if you looked at their GAAP earnings per share, generally accepted accounting principles, it looked like an absolute rocket ship.
But underneath the surface, the underlying economics were severely deteriorating.
Severely.
Why? Like, what were they missing?
The fundamental problem was that they lacked the adequate data and tools to forecast loan profitability at the time of origination.
They were just guessing.
They were flying completely blind, mistaking pure volume for actual economic value. You have to understand that in subprime lending, accounting can be very deceptive.
Explain that a bit more.
Well, under the old accounting rules, you could book a lot of the anticipated profit up front when the loan was signed.
Right, day one.
Day one.
Ugh.
But the defaults wouldn't actually materialize until months or even years later.
Oh, wow.
So in a period of rapid growth, your upfront profits totally mask the rod building up in the back half of the portfolio.
It's like eating a ton of junk food. You feel great the day you eat it, the energy spike is incredible, but the health consequences don't show up until much later.
That's exactly it. And for CACC, that health consequence almost killed them. The late 90s brought a massive reality check.
Yeah, so what happened?
Well, in the third quarter of 1997, they finally developed and installed a new forecasting system. It was designed to predict future loan cash flows with better precision based on their historical data.
Okay, that sounds like a good thing.
It was a good thing. But the moment they turned the system on and ran their existing portfolio through it, the alarm bells rang.
Oh.
They realized their portfolio was an absolute mess. The loans they had been writing for the past few years were performing terribly.
They had to take a massive $60 million charge in 1997.
Which was huge for them at the time.
It resulted in a huge quarterly loss. Wall Street panicked. Lenders were waiving covenant violations. I mean, the actual survival of the business was in question.
Completely in question.
And it wasn't just a one-off adjustment either. 2 years later, in 1999, the ghosts of those bad loans were still haunting them.
Still trickling through the system.
Right. They had to take another $60.8 million charge and posted the only annual loss in the entire history of the company.
Which is why this period of history is absolutely vital for our skeptical framework today.
Why is that?
Because it completely shatters the myth that credit acceptance always possessed some magical, infallible algorithm.
They did not?
They did not. They nearly ran the business right off a cliff because they prioritized growth over unit economics. So as an investor looking at the company in 2026, that historical error should permanently lower your willingness to just blindly accept current management's rhetoric about how great their data and AI models are today.
Right. Trust should be based on observed learning and continuous execution, not just polished corporate language.
Exactly.
But to their credit, they did learn. I mean, the turnaround that followed that 1999 crisis is basically the stuff of Wall Street legend.
It really is. It was decisive, and it required a complete cultural reset. In 1999, a man named Tom Triforos joined the board of directors, and he essentially brought the hammer down. He instituted a culture of extreme financial discipline centered around a strict minimum required return on capital.
Let's translate that for a second, because minimum required return on capital sounds very textbook. What does that actually look like on the ground for, say, a sales rep or an underwriter?
It means no more growth for growth's sake, period. If a loan didn't meet their rigorous internal threshold for profitability, they just didn't write it.
Even if it meant losing market share.
Even if it meant losing market share. Even if it meant the sales team missed their volume targets and didn't get their bonuses.
Wow, that is tough to enforce.
It's extremely tough.
Yeah.
They aggressively cut weak dealer relationships, they stopped trying to conquer the world, and focused entirely on the quality of the loans. They paid down debt.
And the discipline worked.
It did. By year-end 2000, their actual invested capital had fallen from its 1997 peak, meaning the company physically shrank.
Which Wall Street usually hates.
Wall Street hated it.
Yeah.
But, crucially, their loan returns were finally exceeding their cost of capital again. They were making real economic profit.
And because Wall Street had abandoned the stock, the shares were trading at incredibly cheap valuations.
Pennies on the dollar.
So what did they do? They started buying back their own stock like crazy. Between August 1999 and the end of 2000, they bought back over 3.8 million shares at an average price of around $5.
Incredible capital allocation.
It's just incredible. Then in 2001, they rolled out their internet-based origination system, CAPS. In 2002, Brett Roberts becomes CEO, having been in the trenches in finance roles since the early 90s.
Right.
And under Roberts, from 2002 all the way to 2021, the company just thrived. They navigated the 2008 financial crisis, they navigated the pandemic, all by obsessively focusing on capital allocation and maintaining a margin of safety.
That narrative arc, from near death due to hubris to a highly disciplined compounder, is incredibly favorable when you study the company's past.
It's a great story.
It proves that they didn't just tweak an algorithm. They built a culture around unit economics. And that culture is why they have historically looked vastly superior to other subprime lenders.
Because the others just kept chasing growth.
Right. Many of them just treated credit expansion as a substitute for actual underwriting intelligence.
Okay, so if you are listening to this, you might be thinking, great. They learned from their mistakes in the 90s. They built this supposedly impenetrable culture over 25 years. They survived 2008. Why shouldn't I just trust them today? Why all this skepticism?
And that brings us to the most significant transition in the company's modern history. We call it the management cliff.
The management cliff.
The architects of that legendary discipline, the people who actually lived through the 1997 near-death experience, The executives who forged that paranoid, hyper-disciplined culture, they are gone.
They are completely gone. Let's look at the timeline. Brett Roberts, the legendary CEO, retired in 2021.
Yep.
Kenneth Booth took over, but he retired in 2025. Now, as of November 2025, Vinayak Hegde is the CEO.
Right.
And it's not just the top job. If you look at the early 2026 proxy statement, a whole slew of legacy executives all retired almost simultaneously.
Mass exodus.
The former Chief Treasury Officer Douglas Busk, former Chief Analytics Officer Arthur Smith, and former Chief Sales Officer Daniel Ulatowski. All gone in early 2026.
That is a massive, coordinated brain drain. It's basically an institutional memory wipe.
Seriously.
The people who knew exactly which levers to pull when the credit market seized up, they are no longer making the decisions.
It's like discovering that the master engineers who built the suspension bridge you drive over every day have all retired.
Exactly.
And the new crew has only read the manuals. I mean, the bridge is still standing, but you're pricing the stock based on the ghosts of management past.
Precisely. The historical trust premium that investors have traditionally assigned to CACC stock must be heavily discounted today. Continuity cannot be assumed under a skeptical framework.
It has to be reproven.
It must be reproven. The current top team is entirely new. Now, Hegde has a new playbook. He's talking about enhanced segmentation, AI-driven underwriting, cost reductions.
I think there was a recent 6% workforce reduction, right?
Yes, there was. But right now, that is mostly narrative. It's some early operational cleanup. This new team has not yet been tested across a full, agonizing credit cycle under their own strategy.
So the old guard is gone, and the new executives have to prove they can keep this massive machine running. Which means we can't rely on the history books anymore.
No, we have to look at the present.
We have to look at the actual car lots today. We need to examine the current operating evidence to see what the new regime's grip on the market really looks like. So let's talk about the dealers. What is happening out there on the ground?
Let's start with the size of the ocean they are swimming in. The macro opportunity is vast.
It is huge.
A 2026 Congressional Research Service report noted there were 108 million open auto loans at the end of 2025. That represents $1.67 trillion in outstanding auto debt.
1.67 trillion. That is wild.
And Experian data shows subprime borrowers accounted for over 22% of used vehicle financing in late 2025.
So CACC is absolutely not constrained by the size of the market. The demand for subprime auto credit in America is perpetually massive.
Perpetually. But the opportunity being huge doesn't mean CACC is capturing it well. In fact, their capture quality seems to be faltering right now.
Let's look at the vital directional shifts here. Because in 2025, CACC enrolled over 5,700 new dealers. They ended the year with a record high of 15,745 active dealers.
Right.
And then the first quarter of 2026, they hit another Q1 record for active dealers, nearly 11,000. So if you just read the headline, it sounds amazing, right? Record dealer count.
It sounds fantastic.
But when you dig into the unit economics, the productivity is tanking.
This is a critical divergence. Yeah. In 2025, total unit volume, the actual number of loans they originated, fell by over 12%.
Think about the math there for a second. They have more active dealers than ever before in their history, but they are writing 12% fewer loans.
Exactly. The average volume per active dealer plummeted over 14%.
Oh.
And the result? Management had to disclose that their market share in their core segment, which is used vehicles financed by subprime consumers, dropped from 5.2% in early 2025 down to 4.5% in early 2026.
Active dealers are going up, but individual productivity and overall market share are going down.
Right.
It's a treadmill effect. You can picture it. It looks like they are sprinting just to stand still.
That treadmill analogy perfectly captures the risk here.
Right. If you are adding record numbers of dealers, throwing all these resources at sales, marketing, and onboarding, but your overall market share is actually shrinking, you are essentially filling a leaky bucket with lower quality relationships.
Yeah.
You're working much harder to get less output. Why is this happening? Like, why would a dealer sign up with CACC but then not actually send them volume?
Because of competition and friction. A dealer might sign up with CACC as a backup option, but if a competitor across the street offers a higher upfront advance rate or a faster approval process or requires less burdensome paperwork,
The dealer is going to send the loan to the competitor.
absolutely. Dealer count without dealer productivity is incredibly dangerous.
Right.
It means your sales force is penetrating lower quality or less productive relationships. just to hit their onboarding targets. But those relationships aren't yielding economic fruit.
Now, in fairness to management, they aren't totally ignoring this. They claim they are carefully diagnosing where they are losing market share, and they are focused on reducing dealer friction rather than just slashing their prices to buy volume.
Which is true.
They are holding the line on their return requirements.
And that tone is encouraging because it shows a degree of the old discipline. They aren't panicking and dropping their underwriting standards just to inflate the volume numbers.
No.
But from an investment standpoint, a company that is actively diagnosing share loss is acting reactively.
They are on their heels.
They're operating from a position of pressure, trying to figure out why the market is moving away from them. They are not operating from a position of unassailable strength.
Right. If they truly had a...
Exactly. Instead, the near-term data shows that their growth expectations are extremely fragile.
Which leads directly to the next logical question. If their market share is shrinking and competitors are aggressively stealing volume, are CACC's pricing power and unit economics holding up under this pressure?
This brings us to the concept of the moat and the reality of the squeeze.
Let's get into the squeeze. Because you mentioned earlier that their moat is a process moat. It's built on decades of collection data, a refined credit scorecard, and a massive servicing infrastructure.
Right.
But it is not a switching cost moat. For you listening, a switching cost moat is like Apple's ecosystem.
Great example.
It's incredibly painful for you to switch from an iPhone to an Android because all your photos, your apps, your family group chats are tied up in it.
Right.
CACC does not have that. A used car dealer can and absolutely will jump ship to a competitor on a loan-by-loan basis if that competitor offers a better upfront advance rate. There is zero loyalty in deep subprime.
Zero. Deep subprime lending is an unforgiving, hyper-transactional, data-intensive business. CACC's process moat is real. They are very good at collecting bad debt, but it's narrow.
And we are starting to see cracks in their supposedly infallible data advantage.
We really are. Let's talk about the vintages.
Okay, just briefly for the listener, a vintage in lending is just the cohort of loans written in a specific year.
Exactly. So if you look at their recent historical collection data, the older vintages from 2019 and 2020 performed above their initial forecasts.
Okay.
They collected more money than they originally modeled. But the 2022 and 2023 loan vintages performed materially below initial forecast levels.
How far below?
For example, purchase loans from 2022 were forecasted to collect at 68% of the loan value, but they actually came in at 61.3%.
Whoa, that's a massive miss. To miss by nearly 7 percentage points for a company whose entire multi-billion-dollar valuation and reputation is built on forecasting precision, that is startling.
It's very concerning.
Why did the algorithm fail so badly on those 2022 loans?
It essentially comes down to macroeconomics. In 2022, inflation was rampant, and used car prices were still highly elevated from the pandemic supply chain shocks.
Right.
When a subprime consumer defaults, the lender repossesses the car and sells it at a wholesale auction to recover some of the loan value.
Okay, so if the car was overvalued when they wrote the loan.
Exactly. If used car auction prices plummet between the time you write the loan in 2022 and the time you repossess it in 2024, your recovery rate collapses.
So the algorithm isn't magic.
No, it's not magic.
It undermines the claim of unusually stable underwriting. They are subject to macro forecast errors and vehicle depreciation curves just like anyone else.
Right. If inflation eats the consumer's wallet and the repossession auction values drop, CACC bleeds.
Yeah. And this brings us to what might be the single most critical insight in this entire deep dive.
Yes.
If you take nothing else away from this analysis, you need to understand the spread compression. We have to heavily emphasize this. The economic value creation of this company has compressed sharply from its post-pandemic highs.
Very sharply. Let's look at the numbers straight from their 2025 shareholder letter.
Okay, lay it out for us.
In 2021, CACC generated an adjusted return on capital of roughly 13.5%.
Great number.
Yeah. Their cost of capital, the interest they pay to borrow the money they lend out, was 5.4%.
Okay.
So the spread, the actual economic value they are creating above their costs, was 8.1%.
That is a massive, incredibly healthy margin of safety.
A phenomenal business.
Yeah.
But look at 2025. That adjusted return on capital fell from 13.5% down to 9.4%.
Ouch.
And at the same time, because interest rates across the economy went up, their cost of capital rose from 5.4% to 7.4%.
Okay, wait, let me do the math here.
Go ahead.
So The spread shrank from over 8% down to a razor-thin 2%.
Yes, the spread shrank from 8.1% to 2.0%.
Wow.
This is the single most important disconfirming data point in the entire report. A spread shrinking from 8% to 2% is not a blip. It is a fundamental structural shift in the profitability of the engine.
Okay, wait, let me push back here.
Right.
Because I can hear a value investor listening to this saying, hold on, they are still earning a 9.4% return on capital. Their cost is 7.4%. They are still earning 2% over their cost of capital. They are still technically profitable on an economic basis. Why is this the single most disconfirming data point? Isn't a profit a profit?
That is a very fair pushback, but you have to consider the context.
Okay.
If we were evaluating a highly regulated, federally insured, incredibly stable regional bank, a 2% spread might be acceptable.
Right.
But remember our core mission today. We're evaluating this stock to see if it deserves exceptional long-term trust. A business that is barely clearing its cost of capital during a period of ordinary non-recessionary competition is not an exceptional compounder.
The margin for error is effectively gone.
Precisely. In a controversial, cyclical, highly volatile, funding-dependent niche like deep subprime auto lending, a 2-point spread leaves absolutely zero room for complacency.
Right, because what happens if inflation ticks back up and funding costs rise another 2%?
Exactly.
What happens if there is a mild recession, unemployment rises, used car prices drop, and the recovery rates fall another few percentage points?
The spread goes negative.
They start destroying capital on every loan they write.
Exactly. And the pressure isn't just coming from the credit side.
What else?
On top of the shrinking gross margins, their operating expenses are creeping up. Operating expenses as a percentage of adjusted average capital rose from 6.1% to 6.6% recently.
No, for the listener, going from 6.1 to 6.6 might sound like pennies.
It does.
But in a business where your gross profit margin has collapsed to just 2%, a 0.5% increase in overhead is a massive leak in the boat. Why are those expenses going up?
Because of that treadmill effect we talked about earlier.
Ah, right.
They are spending more money on the sales force to recruit dealers, more on advertising, and more on professional services, just to keep the machine moving.
They are physically spending more to get less market share, all while their fundamental credit spread has collapsed.
It is a textbook margin squeeze.
Man. So with margins squeezing like a vice and the old management team out the door, we have to look at the balance sheet. Does this company have the financial armor and the corporate governance to weather a potential storm if that 2% spread goes to zero?
We definitely need to open up the war chest.
Let's do it. Let's look at their financials, capital allocation, and executive compensation structured.
Let's start with liquidity, the lifeblood of any lender.
Okay.
On the immediate funding front, they're currently fine. They are not in imminent distress. As of March 31st, 2026, they had over $1.2 billion in unused revolving credit lines.
That's a solid cushion.
It is. Furthermore, they just successfully completed a $450 million asset-backed securitization, an ABS deal, in May 2026 at a favorable all-in cost of 5.2%.
Let's do a quick ELI 5 on that for the listeners who don't live in the bond markets.
Good idea.
An ABS deal, or asset-backed securitization, is basically how CCC funds itself. They take thousands of these individual subprime car loans, bundle them together into a giant pool, and sell slices of that pool to large institutional investors,
Right.
like pension funds or insurance companies. The investors buy it because it pays a steady yield, and CCC gets a huge lump sum of cash up front to go write more loans.
That is exactly right. It's the plumbing of their business. And management proudly noted that the 5.2% rate they got on this May 2026 deal represented the lowest credit spreads they've seen since late 2021.
So the bond market currently is willing to fund them cheaply.
Yes, but you have to look at the total balance sheet.
Right.
The balance sheet itself is heavily leveraged. They have total balance sheet indebtedness of over $6.4 billion against roughly $1.5 billion in actual equity.
That's a leverage ratio of about 4.2x.
Exactly. Now, I know this debt is tied directly to those auto receivables, so it's not exactly like a software tech company carrying 4x debt on nothing but goodwill.
Right. There are physical cars and loans backing it up.
But it still means they are completely existentially dependent on the capital markets functioning smoothly.
Because if the ABS market freezes up, like it did in 2008 or briefly in 2020, CACC freezes.
Yes, they can't originate new loans.
That is the key takeaway on leverage. Adequate funding access today should not be mistaken for structural all-weather resilience.
No, they are highly reliant on the kindness of strangers in the bond market.
Always a risky place to be.
Now, let's pivot from how they raise capital to how they spend it. Capital allocation.
Let's talk about it.
Historically, their absolute superpower has been stock buybacks.
Right. As we discussed, it's what saved them and compounded shareholder wealth in the early 2000s.
And they are still executing this playbook aggressively.
Huh.
They bought back 1.5 million shares in 2025 for about $725 million
Wow.
and another 365,000 shares in the first quarter of 2026. Because of this, their total share count has dropped from 12.5 million at the end of 2023 to 10.4 million in early 2026.
Okay, and here is my major inquiry into that strategy.
Go for it.
Historically, buying back stock when the shares were dirt cheap and the return on capital was massive, that was brilliant. It created legendary wealth.
It did.
But doing it right now, when your economic spread has shrunk to a measly 2%, your market share is slipping away to competitors, you are adding overhead expenses, and your legacy leadership team just walked out the door.
It's a very different picture.
Right. Is throwing $750 million at stock buybacks still a brilliant use of capital? Or is it just corporate muscle memory? Are they doing it just because that's what they've always done?
That is a very fair, highly critical question.
Thank you.
A company facing compressed spreads and massive leadership transitions isn't automatically wrong to repurchase stock.
Mm-hmm.
I mean, reducing share count does mathematically boost earnings per share, but they are no longer obviously exercising the extreme conservative capital allocation that made their earlier buybacks so impressive.
Right. It lowers the confidence score. It feels a bit like financial engineering to mask operational sluggishness.
It definitely can be seen that way. And speaking of leadership transitions, we must dive into the executive compensation structure because it is highly unusual and, frankly, a bit concerning.
Oh, this part is fascinating. Let's talk about the new CEO, Vinayak Hegde. When he took over in late 2025, he received a massive upfront restricted stock unit grant.
Massive.
We're talking 140,000 RSUs valued at over $61.6 million on the grant date. $61 million, day one.
Day one. And the proxy states this is intended to cover a 10-year period, effectively replacing his annual equity grants and most of his annual cash incentives for the next decade.
Now, you can look at this from two perspectives.
Okay, give me the bull case first.
On one hand, you can argue this creates incredible long-term alignment. He is locked in for a decade. His wealth is intimately tied to the long-term performance of the stock. He's not going to manage for quarter-to-quarter blips.
But there is a massive flip side to that argument.
Yes, there is.
Enormous upfront grants dilute the board of directors' ability to re-underwrite his performance on an annual basis. Think about it.
Right.
If he radically underperforms in year 2 or 3, the board doesn't have the standard leverage of withholding his annual equity grant to force a change in behavior. Why? Because he already has it all. The chips are already on his side of the table.
Exactly. It reduces ongoing accountability. And when you look deeper into the proxy statement, it specifically notes that the compensation committee explicitly ignores peer benchmarking. That stood out to me.
They don't use external compensation consultants to see what other CEOs in the industry are making. They just do it their way.
Which honestly can signal incredible independence from the typical Wall Street consultant racket where CEOs just benchmark each other to inflate their own pay.
Sure.
That independence is cool in theory, but it can also signal dangerous insularity. When you combine an unproven leader in a complex industry, no external peer benchmarking, and massive upfront payouts that limit future accountability, it doesn't exactly scream best-in-class governance.
No, it doesn't. It creates a trust us dynamic.
Yeah.
And they are asking for that trust us dynamic precisely at the moment when the visionary executives who originally earned that trust over 25 years are no longer in the building.
It's asking a lot of the modern investor.
It is. And this also brings up the issue of concentrated ownership.
Mm-hmm.
Directors, executive officers, and legacy founder-related entities still hold large chunks of the stock.
Yeah.
Now, while concentrated ownership can sometimes preserve long-term thinking, it doesn't solve the key man transition risk we are talking about. It might just mean that these legacy holders dominate shareholder votes.
essentially reducing the open market's ability to signal displeasure or force changes if the new management team falters.
Exactly.
If the broader market hates the direction the company is going, the concentrated insiders can just outvote them anyway.
Yep.
Okay, speaking of things that obscure the view for everyday investors, let's turn to the accounting.
The fun stuff.
Let's look at how the company actually presents its profitability to the public, and more importantly, the legal landmines they have buried deep in the footnotes. Let's grade their own homework: forensic accounting and red flags.
So the accounting for subprime loans is notoriously messy. A few years ago, the accounting standards actually changed. Under a framework called Current Expected Credit Losses, or CECL accounting, JAP requires companies to front-load provisioning for expected losses.
Okay, let's translate CECL accounting for a second, because this is where a lot of investors get lost in the weeds.
Please do.
Basically, the rules force a lender like CACC to declare all the losses they expect to take on a bad loan up front on day one, the moment they write the loan.
Right here.
But the actual interest income from that loan is going to trickle in slowly over the next 4 or 5 years. So mechanically, it makes them look much poorer today than they actually are, because they are taking the full hit of the loss immediately, but deferring the revenue.
Exactly. It creates a complete mismatch in timing. Management repeatedly argues that GAAP accounting, because of this CECL rule, distorts their true economics and makes their growth look punishing.
And they are probably right about that specific mechanic. CECL is very messy for subprime.
It is. So to solve this, management pushes investors to ignore GAAP and instead look at their custom internal non-GAAP metric called economic profit.
Economic profit.
Yes. They essentially adjust the numbers to show what they believe is the true economic reality of the cash flows.
And as an investor, you generally want to see how management views the business.
Sure.
But the skeptical problem here is that management's custom solution gives itself substantial unchecked discretion. Economic profit depends entirely on management-defined adjustments.
Right.
And here is the massive blind spot. This is the ultimate red flag in this entire deep dive. Management's favored economic profit metric completely excludes contingent legal losses.
It's a staggering omission.
It's wild. Let me read the actual numbers from the sources. In 2025, Credit Acceptance recorded a $74.2 million contingent loss for legal matters.
That's a huge number.
By March 31st, 2026, their total legal accrual balance on the balance sheet was over $82 million.
Wow.
And yet, when they present their shiny economic profit metric to investors on earnings calls showing how well the business is supposedly doing, that $74 million expense is just ignored.
Backed out.
Erased from the headline number.
They treat it as non-operating noise. They classify it alongside one-time restructuring charges or unique tax hits.
That is insane. That is like a massive trucking company presenting their annual profits to you, but conveniently leaving out all the speeding tickets, the blown tires, the out-of-court settlements for crashes, and the Department of Transportation fines, claiming they are one-time expenses.
Perfect analogy.
But getting those tickets is structurally baked into how they drive. If you are a deep subprime lender operating at the very bottom of the credit spectrum, regulatory scrutiny and lawsuits aren't background noise. They are a permanent structural feature of your business model.
That trucking analogy hits the nail squarely on the head. When legal and regulatory risk is structurally tied to the very nature of your business model, excluding large legal settlements from your favorite performance metrics is highly deceptive.
It makes the business look significantly cleaner, more predictable, and more profitable than it actually is in reality.
Because the cash still leaves the building to pay those lawyers and settlements, whether they include it in economic profit or not.
So what are these legal threats, specifically? Because $82 million is a lot of money to have accrued for lawsuits.
The primary threat right now is at the state level. The New York Attorney General and a multi-state coalition are actively circling the company.
Okay.
They sued CACC in 2023, alleging deceptive and abusive practices. The company noted in early 2026 that they reached preliminary alignment on material terms of a potential $75.5 million settlement involving New York and several other states.
Now, to be clear for everyone listening, When we talk about the New York Attorney General or the Consumer Financial Protection Bureau, the CFPB, which actually withdrew as a plaintiff in April 2025, a minor win for CKCC,
Yes.
we are not taking a political stance on consumer protection laws. We are evaluating this strictly objectively as a financial risk to the business model.
Right. We don't care about the politics. We care about how regulatory intervention changes their unit economics.
And the risk here isn't just that CACC has to cut a $75 million check to New York, right? I mean, they generate cash, they have a $1.2 billion credit line, they can pay a fine. What is the real existential threat of this litigation?
The real threat is operational changes.
Tell me more.
The risk is that the settlement or ongoing enforcement pressure forces CACC to change its actual lending practices in a way that destroys its economics.
Give me an example.
What if regulators force them to alter their affordability assessments, making them reject more loans? Or what if they cap the dealer markups, destroying the incentive for the dealer to use the portfolio program?
Right.
What if they force changes to their aggressive collections behavior?
That's the terrifying part for an investor. If a state forces you to underwrite differently or collect differently, your already razor-thin 2% economic spread could vanish overnight.
Exactly.
The legal overhang is only partially resolved by paying a fine. The operational risk, the threat to the algorithm itself, remains permanent.
The fine is just the cost of admission. The operational restrictions are what slowly strangle the business.
Okay, so let's put this all together into the stress test.
Let's do it.
If we take all these pressures, we have shrinking economic spreads down to a microscopic 2%. We have a massive loss of the legacy leadership team and institutional memory. We have massive legal threats that are conveniently hidden from management's adjusted metrics. And we have a tightening consumer base where a record number of dealers are actually less productive.
It's a lot.
Where does this inevitably lead? If you hold this stock, what are the failure scenarios?
Well, let's invert the problem first. For this stock to be a great compounding investment today, you basically need 5 distinct assumptions to hold perfectly true simultaneously.
Okay, let's hear them.
1. CKCC must stabilize or regain their falling market share without loosening their pricing or underwriting standards.
2.
2. The funding markets, the ABS markets, must remain wide open and relatively cheap. 3. These massive legal settlements must remain manageable and, crucially, not force any operational concessions.
Got it.
4. The new unproven CEO, Vinayak Hegde, actually improves execution and validates his $61 million payout.
And 5.
And 5. The non-prime consumer, the borrower at the very bottom of the economy, has to stay resilient against inflation.
That is a very tall order, and as we've discussed for the past hour, assumption number 1 is already cracking. Market share is actively falling.
It is.
So if these assumptions fail, what is the downside? Does the company go bankrupt tomorrow?
No. The most likely downside scenario isn't a sudden dramatic bankruptcy like Lehman Brothers. It's a slow grind.
A slow grind.
In this scenario, dealer counts keep rising, but the actual volume per dealer stays incredibly weak. The economic spread remains positive, but mediocre, maybe hovering around that 1% or 2% mark.
Okay.
They use their cash to buy back stock, which keeps the earnings per share looking respectable on the surface, and they settle the lawsuits without dying. But the stock delivers terrible, middling returns for the next decade because the company never manages to re-widen its value creation spread.
It becomes a value trap.
Exactly.
It traps investors who look at the beautiful 25-year historical chart and think they are buying a dynamic compounder, when in reality they are buying a stagnant, mature, heavily regulated lender whose best days are behind it.
That is the slow bleed.
Yeah.
But then there is the sharper, more painful downside.
Oh, boy.
The recession shock scenario. If used car prices drop significantly, the health of lower-income consumers worsens due to rising unemployment,
Yeah.
and the ABS funding spreads widen simultaneously, which historically all tend to happen at the exact same time during a credit crunch.
Right.
Management will be trapped in a vice. They will have to choose between writing bad loans just to keep their volume up, or writing no loans at all and watch the company shrink violently.
And in that shock scenario, what happens to the stock price? Because right now, the stock trades at a price-to-earnings ratio, a PE, of roughly 13.3x. For listeners who follow standard valuation metrics, a PE of 13 is practically deep value investing territory. It looks incredibly cheap compared to the broader market.
It is an optical trap.
Why?
A mid-teens multiple is actually too high if those trailing earnings benefited from falling funding costs that are now reversing,
Yeah.
or if that earnings number excludes the structural reality of massive legal costs.
That makes sense.
In a shock scenario, the market stops treating CACC as a disciplined compounder that deserves a premium and starts pricing it as a leveraged cyclical specialist lender.
And then what happens?
The multiple could compress significantly. The stock could get cut in half, even if the business survives. Simply put, the stock is not a high-confidence, high-quality certainty today.
Wow. Okay, this has been an incredibly intense, eye-opening ride. We've gone from the mechanics of a used car lot to the intricacies of CECL accounting and executive compensation.
We covered a lot of ground.
Let's recap the core takeaways for the listener so they have a clear, actionable summary of this AI investment memo. I see 4 main themes here that invalidate the bull case.
Let's hear them.
First, the management reset. The historical discipline that made CACC a great, resilient company was built by executives who are simply no longer in the building. You are betting on a new team that hasn't proven itself through a crisis.
Spot on.
Second, the squeeze. The margin of safety is effectively gone. The spread between their return on capital and their cost of capital has collapsed from over 8% down to just 2%. The engine is running hotter, yielding less power.
Absolutely critical point.
Third, the treadmill. Record active dealer networks are a mirage. They are masking severe drops in individual dealer productivity and a shrinking overall market share in their core segment. They are working harder to lose ground.
Yeah.
And fourth, the illusion of profit. Management's custom economic profit metrics are highly deceptive because they hide massive recurring legal and regulatory costs that are structural to the deep subprime business model.
That is the perfect summary. Based on the rigorous, skeptical buy-side framework we established at the beginning, the final verdict is clear.
What's the verdict?
Credit Acceptance Corporation is an incredibly impressive historical case study of how to navigate subprime lending in the past. But it is an insufficient present-day quality investment for your fresh capital. The risks simply outweigh the shrinking rewards. It fails the test of exceptional long-term trust.
We started this conversation talking about a building's foundation. We asked if you trust the building itself or the master engineers who built it. CKC survived for 25 years, balancing on shifting, dangerous sand because they had masterful engineers.
They really did.
But I want to leave you with this one final provocative thought to mull over as you review your own portfolio. If a company's deepest, most impenetrable competitive moat was a culture of extreme financial discipline, forged in the fires of crisis over 25 years, how exactly do you price that stock the morning after the architects of that culture walk out the door for good?
That is the multi-million-dollar question.
Thanks for joining us on this deep dive.